You ever have this dream? I've had this dream maybe 5,000 times where you're falling and you're falling. And you know at some point you're going to hit the ground. And I actually, when I was a teenager, I heard this thing that if you actually do hit the ground in your dream, you die. But then I thought, how do you know, right? I mean, you can't go and wake the person up after they're dead and say, hey, did you die because you hit the ground? You don't know. But if you've ever had that dream where you're falling and falling and falling, the stock market kind of feels like that right now, doesn't it? The bad news? If history is any guide, kids, the falling has only just begun. Live from the 3-room apartment above Uncle Jack's garage, while the basement, 3 weeks away, kids, 3 weeks away till the basement's renovated. Hey there, stackers. I'm Joe Saul-Sehy, Average Joe Money on Twitter. Welcome to Money in the Morning, the show where we got to go over not one, but two headlines ripped, in this case, from the very, very, very current press. And not only do we talk about what those mean to your wallet, we also put them together at the end of the show in a segment we call The Big Idea. Money in the Morning is brought to you by Hurdler, spelled Hurdlr. Whether you're somebody just starting off on your journey alone as a solopreneur, you know how you get to this time of year, you're like, man, I need to start a side hustle, make a little extra money for the holidays. Hurdler is something you want to get immediately because it automatically tracks all your mileage, your expenses, your income streams, and tax deductions in real time. On average, people find over $5,600 in tax deductions. Get the app if you use our link on your phone, stackybenjamins.com/hurdler. You'll find that you'll be another person among the $6 billion in finances tracked, $250 million in taxes saved. That's some big numbers. stackybenjamins.com/hurdler. All right, we got some headlines to hurdle, don't we? So, Laura, why don't you fire up the show?
Here come two headlines ripped from the financial press, only at Money in the Morning.
I don't know if you know this, but the stock market's been going down. I know, shock. I know if you've been asleep, you haven't had any media except Money in the Morning. You may not know the stock market has just been going on a wild, wild ride lately. On the Afford Anything podcast recently, I called it delightfully jiggly, right? Because it hasn't yet begun to really, really go down. In fact, the stock market as of end of last week was still up for the year. But as we're recording this mid-morning on Monday, the Dow drops 500 points as market sell-off continues. Bank shares lead the slide. This is according to Fred Imbert at CNBC. Fred writes, stocks traded sharply lower on Monday in a volatile session as banks and Apple led the decline. Traders pointed to a number of reasons for the selling, including an adverse ruling in a Chinese court against Apple, a flattening yield curve, and a delayed Brexit vote in the United Kingdom. I'm going to stop right there because this madness is going to continue, kids. It's going to continue. And the madness is not the stock market going down 500 points. Listen, that's the thing. It just happens. Like, here's what Grandpa Joe is going to tell you. The stock market in an average year has a 14-point swing from top to bottom. And are we there yet? If we are there yet, we're barely there. So is it getting ugly? Yes. Is it super ugly? No. And for those of you that weren't around the last time, and it's funny, I was reading a piece written by a young journalist who was talking to another apparently fairly young person. And I'm not ripping on young people. I'm just saying they interviewed the wrong person because they said, so what did you think the last time this went down? 2007, 2008. Oh, it was awful. I had my first job just out of college. It was absolutely horrible. Yeah, it was horrible. If you're in your first job out of college And you might have learned very quickly that the stock market is bad. You might have learned that real estate is bad, and you might not be investing. In fact, we've done shows that have shown that a lot of millennials have learned those lessons, and those are not the right lessons to learn. But if you were in your first job out of college, it wasn't bad for you comparatively. And by comparatively, I mean, if you were 55 years old and you had all your money in stocks in 2007, your retirement got destroyed, just absolutely destroyed. If you were somebody that went big into real estate, and if you're in your first job out of college, you probably didn't have the wherewithal yet to be big into real estate, you also potentially got destroyed, especially if you use leverage. There were a lot of lessons, and a 23-year-old wasn't the right person to know what those lessons were. And so we're seeing a lot of journalists, a lot of young journalists talking about, I sound like an old guy, don't I? I'm only 50. I'm not like Joe old man, but you're seeing a lot of people doing a lot of gyrating. And I know a lot of it's just for the clicks, but part of it is this: at the beginning of article after article that you're going to read, as this thing goes down and down and down, here's what you're going to find. You're going to find that they're going to find experts that are going to tell you exactly why it went down. Maybe not rule one. I almost said rule one of investing, but maybe not rule number one. But in the top 20 rules of investing, we never have any clue why the hell it goes down. The market decides on one day that news isn't important, and then 2 days later decides it is important. Maybe. The second that you try to put yourself in other people's head and determine why they make trades, which is really what a market is, right? I mean, it's an open market. There's a buyer on one side. There's a seller on the other. Somebody decides today's a great day to sell. By the way, today's a horrible day to sell. But somebody decides today's a great day to sell, and somebody on the other end picks up those shares at a lower price. That is a market. And trying to say that there's specific reasons why all these people traded. And don't get me wrong, I do think these are big news events that do swing markets. But are they the reason? I think you're playing a dangerous game if you decide to get into that. So back to the piece. The piece says that it's an adverse ruling in a Chinese court against Apple, a flattening yield curve, and a delayed Brexit vote in the UK. Yes, yes, and yes. Those are all reasons. Are those the only reasons? Could be just a general malaise. You could have people, big investors that are in their 50s going, you know what? I don't know if this time I can get it back. I'm pulling my cash because of all of those reasons and more. Just the general mood we talked about on our last show about the fact that there probably is a recession coming, you know? When we look at that flattening yield curve, no false positives. There's always been a recession after that. Does it mean it's going to happen again? No. But it has never not happened that way. So there probably is a recession coming. And if that's the case, then that's another reason that we stoke on the fire. Don't worry about the reasons. Start off with your own plan. Start with the end in mind. When do you need the money? And do you have enough time to write it out? Because if we go back to 2007, 2008, or for those of you old guys like me, 2000 to 2002, you go back through those. If you had money in the market in 1999 and you still have it in the market today, you now have been through two of these, and you've got a market going down now, and you're still way, way, way ahead of where you were back in 1999. Forget about it. I'm horrible at that. The New York, New Jersey, forget about it. Accent thing. Good stuff. Actually, bad stuff. I'm not going to read any more of this. Yes, the market's down 500 points. What is telling? So I will jump into this a little bit. What is kind of telling? Bank shares leading the way. Bank shares generally lead the way in a lot of downturns. And the reason why bank shares lead the way is because it's more difficult for banks to make money in a down environment. So when we see the market go down, 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 and interest rates are also low, people aren't investing a ton of money in the banks. Banking fees might dry up. There's a lot of fears around banking. So that's also, to my mind, another recessionary sign. Do I trade on that? Absolutely not. Just another thing to file in your filing cabinet, your mental filing cabinet. Let's say hello to our friends hanging out with us on Facebook, see what they think about this. Kevin says, listen to old Joe touting the efficient market hypothesis. Yes, as if I came up with it too, Kevin. Yeah, good stuff. Chloe's here. We haven't seen Chloe in a little while. Hey, Chloe. Chloe says, yes, Joe, I only allow myself to listen to Stacky Benjamins or Money in the Morning because I don't allow myself to listen to any other news. That's why Chloe is our BFF. Specifically, why she's our BFF. Kurt is baiting me, saying, is it time to sell? Nice job, Kurt. Andy is here. Hey, Andy. Andy says, Green Monday sale on Wall Street. The problem is, if you agree with the last headline we had a couple days ago, Andy, sales probably going to get better. So I think that, well, we could talk about defensive strategies later, but I think that I either continue just buying the way that I'm buying, but I don't know that I have a bunch of, as OG puts it, dry powder on the side and I'm investing it all today. We're still in, or very close to, normal market territory. Maybe we've just entered correction territory, right? Bear market, I don't know. I don't know that we're there yet. We also have Kimberly here. Kimberly says, rather than thinking about the jiggly market, I think about jiggly holiday jello. There you go. Focus on the jello, people, not the 500-point downturn. Scott's here. We also haven't seen Scott here in a little while hanging out with us. Scott says, I got my first big boy job in July 2008. I ignored the headlines and started saving aggressively and haven't regretted it. Man, if you were in a position to do that, that was awesome. And the bad news for people like Scott is all Scott's had is an up market since 2008. Like, it's been fantastic. The VIX, which is the volatility index, has been astonishingly low. It's been incredibly low. So he's had pretty much an escalator that just has gone up and up with a few bumps, right? You had the Brexit bump. You've had a couple hiccups, but generally it has been a nice, smooth escalator until the last few months. Welcome to probably life back as normal. I say probably, and I just said I don't know. So why don't I take that back? Welcome to life, maybe more as normal. That's better. Chris is here. Hey, Chris. Chris says, I'm happy you're here to provide the wisdom. A lot of the podcasts out there from the younger generation that haven't had that much experience. It's funny. I remember, well, thank you first for that. I don't know about wisdom, but I can pontificate with the best of them. The funny thing here is that I remember we were pitched last year for the Stacky Benjamin show by somebody who said, you've got all these morons out there saying that the market only does 8 to 10%. And yet we've averaged, somewhere like 14. And during the time frame that they referenced, that's what the damn market had done. So these guys who'd only been around shortly were like, all these people saying only 10. But hey, we can get you 14. Yeah, investing in an S&P 500 during the time that you did. Take a longer term view. Rebecca's here. Hey, Rebecca. Rebecca said, like you said, I have a plan to stick with it. That's what I do. I've ridden through several downturns and I am still so far ahead. Yeah, it's funny. I remember because back in 2000, I was managing, $70 million of other people's money. And I remember just how horrible I felt every day. But I consistently told my clients to stick with the plan. We did stick with the plan. We did a little bit of turning up the heat in 2001 and 2002, meaning for people with long-term goals, we actually did the opposite. And we, and I'm trying not to use big words, but we increased the standard deviation, the portfolio. I'm sorry, I just puked all over this podcast. We took the investments, we made them slightly riskier. And we did that because the downturn that had been going on for a while, we didn't know when it was going to end, but we did know that they weren't going to need the money right away. So we notched up the risk to hopefully, increase returns. And it absolutely helped us get back more quickly. Michael's here. Hey, Michael. And Kevin says there's lies, damn lies, and statistics. I have heard that 62.5% of the statistics on the internet are made up. I don't know. Just saying. Sorry if you've heard that bad dad joke before. Let's move on to our second piece before I get off in another bad dad joke. Our second piece on a whole different topic comes to us from Market Watch. It is the season. 'Tis the season to have gifts come to your house, and we're seeing it all over the place. The thieves coming and taking your stuff right off your porch. Just amazing. Like, what kind of a scumbag are you that your best use of your day, hey, you know what I'm going to do? I'm going to go take somebody else's crap. I mean, on one hand, when my house got robbed, I thought, God bless them. They probably need the stuff more than I do. They're living a whole different world than I am. It's just stuff. Take it. And that doesn't mean, by the way, come over to my 3-bedroom apartment and take this tree. You could probably have the cactus. The cactus is for sale or for steal, but please don't take the tree. But that's not my point. But, well, let's forget about that point. Let's just get into it. This piece comes to us from Kari Paul at MarketWatch. I thought this was really good. Does insurance cover your stolen packages? It depends. I had never thought about that insurance might cover these packages stolen off your porch. This year, the Grinch is coming for your Amazon packages, and if the Grinch doesn't come, the porch pirate might arrive in his place. People are increasingly falling victim to porch pirates, thieves stealing boxes from porches. A study from insurancequotes.com released this month found. Its holiday hazard study found that some 8% of respondents in a national representative survey of more than 1,000 people have had packages stolen from their front porches. Extrapolated for the rest of the population, that would equate to 26 million people, an increase from 23.5 million people in 2015. With Americans doing more shopping online, porch pirates have many opportunities to steal valuables. People living in doorman buildings don't have to worry about this problem, of course, but those living in multi-unit buildings without a doorman must rely on the kindness of neighbors to lug packages from the porch into the hallway, where in theory, they'll be safe from other residents. Personally, I now get everything from coffee to dog food to deodorant from Amazon, and that doesn't even take into account the myriad holiday gift packages that are going to start arriving over the next few days. So my front porch usually has a package on it 3 or 4 days out of the week, he said. And the more packages there are on porches means more opportunities for theft. So what should you do if you find yourself missing a package? Here's some official and common sense plans to keep your goods safe this holiday season. Insurance plans differ widely. Most basic insurance and homeowners insurance policies don't cover package theft, said Nick DeLulio, spokesman for Insurance Quotes. While consumers can add riders to protect high-value items like specific sets of china, valuable art, or wedding rings, the value of packages is constantly changing, so it's difficult to insure against them. This changes if you have a small business, however. The average cost of home insurance is $35 per month for every $100,000 of home value. Apartment insurance costs an average of $15 per month, but can be as low as $5 per month. By the way, StackyBenjamins.com/lemonade. To be on the low end of that, just saying. Adding a rider will typically add between 1 to 20% of your premium. Now, if you operate a small business out of your home and you get regular scheduled deliveries of certain items, that's a different story, and you'd want to talk to your agent about how certain types of business insurance might protect you there, he said. Representative from Travelers Insurance said all kinds of theft is the 5th most common claim people make, and that it accounts for 5% of all claims. If you do have an insurance plan that allows you to claim something like a stolen package, make sure you think it's worthwhile to do so, said Angie Orban, Vice President of Property Product Management at Travelers Insurance Agency. Most small products sent by mail will not reach the threshold needed to file a claim, she said. Average deductible, $500 to $1,000, so you want to make that worthwhile, she says. Take some preventative measures. Choose a delivery option that requires a signature, track the package, and contact neighbors and ask if you can leave the package with them. Alternatively, have valuable packages delivered to your workplace. Some companies, including Amazon, offer generous refund policies. Amazon has an A to Z guarantee to replace packages purchased through a third-party seller. High-tech options to prevent theft. DeLulio recommends lockbox services like Amazon Key, BoxLocks, and Lamport for delivery workers. The Amazon Key and Home Kit package starts at $250, but can cost more than $300 depending on which lock you use. BoxLock's a cheaper option at $129. Cameras are also obvious remote security devices. The Nest doorbell costs $229, and Ring doorbell starts at $99.99. Always keep these devices, of course, on a secure Wi-Fi network and use a strong password. Found that piece really interesting. This is becoming more and more that time of year. And obviously it's because fewer of us are braving the malls, going out to buy stuff. Instead, even if it is from a place that we buy from all the time, we're just having it shipped to us. I don't know if that's because we're lazy or because it's out there. I've got better stuff to do. That one's my favorite. Much better stuff to do. So check with your insurance policy. I love this idea, though, of make sure the insurance is worth it. And I want to focus on that because a lot of us have insurances that ain't worth it. Here's how you know. Generally speaking, if the insurance policy that you have is really, really cheap, it's one of two factors. Number one, it's because the claims experience is small and it rarely happens. Whatever the problem is rarely happens. Or number two, it's because if it does happen, it's not going to be worth a lot of money. So as an example, if your homeowners has a $500 or $1,000 deductible and you've got a package protection service and a $30 whatever it is, whatchamajiggy shows up at your house, that's not going to be covered anyway. So you got to have a lot of $500 to $1,000 stuff, or actually far enough above $500 or $1,000 to actually make it worth your while. So I'm not sure that's worth it. Now, if you're in a high crime area and it's not considered as part of your deductible, maybe. But for most people, I think some of these other options that we mentioned are probably a better way to go. Let's say hello. See what our friends on Facebook are saying about this one. Kevin asks, is it possible to require a signature from deliveries from Amazon? Amazon has a list of stuff at the bottom of the page when you buy things, and you can check through there for many, many different options. I'll tell you one thing I've done with UPS and with FedEx now that we're here in this 3-room apartment. I've had my stuff held at a Walgreens. If it's from FedEx, they hold it at a Walgreens, maybe half a mile away. Look, for those of you not watching, I just looked toward Walgreens, which even for the people watching, like, why the hell is he looking over there? As if Walgreens is right through the window over there. Yeah, probably not. If it's UPS store, maybe a mile and a half away from my house. So you can do those things. Chris says the same thing, actually. Chris, sorry to steal your thunder there. Did not mean it. Private mailbox store and the office are where I have my stuff delivered. No exceptions, too much risk. Yeah, good stuff there. Chris says there's lots of small businesses. It'll give you a street address and a unit number. They'll receive all your packages. Go by whenever you want. Some have 24 hours. Great stuff. All I had to do, I had to sign up for UPS and FedEx's tracking services. They have I don't remember what it's called, like My FedEx and My UPS. Sign up for those things. Anything that comes by a FedEx or UPS, you can get notifications that it started coming. Once you get that notification that it started coming, and I can get it by either text or email. Once I get that notification, I go in, redirect my setting and say, hey, send it over to Walgreens. And I did it again, by the way. And Chris says there's a CVS right behind you too. There totally is. Kitty corner. And for those people that don't know this, I always thought that was a mistake or somebody was being morons. Like, why would you put these two drugstores always across from each other? They do it on purpose. I found out they do it on purpose because if there's two of them, both of them get more traffic because people think of it as like drugstore corner. And sure, you might not go to Walgreens if it's across from CVS, but the Walgreens themselves gets more traffic if they're across from CVS than if they're not. Didn't know that until just a couple of years ago. Pretty fascinating. But you're right. The CVS, Chris, right over there also. Right there. Good stuff. All right, in just a second, we're going to talk about our big idea for this here podcast. But first, I want to talk about Hurdler again. This is a time of year when people are starting to ramp up their small businesses. You know, you're thinking that you need more money for the holidays. Maybe you racked up some debt. Time to get out of it. We have people on the Stacking Benjamin show all the time that talk about, you know what? The way I got out of debt, I made more money, and I used that to plow through the debt more quickly. Well, if that's you, starting a small business might be the best way to do that. A side hustle. There are tons of easy things you can do. Become an Uber driver, whatever it might be. Hurdler works with all these things. Hurdler automatically tracks all your mileage, expenses, income streams, and tax deductions in real time. And if you've heard me on other podcasts talking about the problems that I had because I didn't understand taxes when I first started as an entrepreneur, you want something like Hurdler. You definitely want to keep track of your taxes and do not get behind with the IRS. Know your profit before and after tax. I had a mentor one time ask me very quickly, first meeting we ever had, How much does it cost you to turn on the lights every day? What the hell are you talking about? Number one thing you need to know, isn't it? How much money do I need to make in a day to equal what it costs me to live? And that's been my MO since about the time that I was 25. So know your profit before and after tax. Got to know that. Whether you're a freelancer, a realtor, a host, a driver, a courier, it doesn't matter what it is. It works with all of them. If you're on your phone, because it works better if you use your phone, head to stackingbenjamins.com/HURDLR, just hurdler without the E, and you'll be able to track every expense, claim every deduction. Good stuff there. Thanks to Hurdler for supporting Money in the Morning. All right, what's our big idea? We got these two pieces that seem to have not much in common, par usual, for this podcast. First, we talked about the stock market being down 500 points. Then we talked about insurances and do you have the right insurances? And I want to talk about insurances against a down market. And I'm not going to say, I think, what you think I'm going to say. I think that you think that what I'm going to say is that long term, staying in the stock market long term is your best friend. It probably is your best friend. But what I do want to say is this. There's no such thing as insurance without a cost. And by the way, not getting insurance is still a decision, and that decision also has a cost. Every time you make a move, there's a cost associated with that move. And so we want to think about what the costs are of those. As an example, you could put a stop loss on your funds. If you've got an exchange trade fund, can't do this with mutual funds, but you can with exchange traded funds. I used to do this with some of my clients. I've done it myself. Take a stop loss, put it below your position where it's trading at today. And then while you're hard at work and the market tanks, you will automatically sell. Now, the bad news is you might not get the price that you wanted, depending on the type of stop loss that you chose. This isn't going to be stop loss 101 day, so I'm not going to go over it too much, but it doesn't guarantee that price. That's cost number one. Cost number two, if you've got a thing like Brexit and it goes down and right back up, you might not get back into the stock market in time. You have to get back in at some point. And so stop losses force your hand to actually have to do something again. There's a cost to that defense mechanism. If you buy options against your portfolio, let's say you own Apple stock or one of these bank stocks going down today, you could buy an option today to sell it at the price that it's at right now in the future. Meaning, if it keeps going down and down and down, you can just get out where it is today later on where maybe you feel like you've got more clarity. Number one, I don't think you'll have more clarity. I think that's an illusion. But number two is there's also a cost to that. You have buying an option. There's that word buy. You've got to buy that defense mechanism. A cost affiliate. What's that cost? Holding. Holding could have a monster cost if you're not holding in the right spot. And I think if the economy is going to continue, the cost of holding can be very, very low. However, if you don't have the right asset allocation and you hold, well, then it could cost you a ton. There's cost affiliated with everything. And that's the thing about the insurance. When we had the piece about insurance earlier, think about the cost of that insurance before going and buying it. Think about the cost of the lockbox before locking up something that's going to protect $5 packages. Cost, benefit. Good stuff, guys. Thanks for hanging out, everybody, on Facebook. Thanks to everybody listening at home. By the way, thanks to everybody who's left a review of this podcast. I absolutely love some of the reviews coming in. Thanks to everybody who's supported our little Money in the Morning show. And lots of fun stuff to come here. Just going to foreshadow that. All right, guys. Go stack some Benjamins. We'll see you next time back here at Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement. without first consulting with your financial advisor, and second, having your head examined. Have a headline you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.